这个群友们，大家晚上好啊！首先非常开心，在今天的这个周五的晚上8点钟，我们在这个云聚会哈。那么呢，我是今天的主持人杨小安 Angela 杨。那么可能在之前的这个老一点的群友们啊，可能看到之前我有帮房东群做过很多线下的主持活动。那么今天呢，也是非常的荣幸啊，再次可以来到房东群的这个线上的讲座。那么今天呢，也是非常开心，我们邀请到了房地产方面的贷款和商业贷款的专家Steve Fabian 给我们带一场非常精彩的讲座。那么他将为大家介绍的是加拿大贷款机构的全局观并且加拿大贷款机构如何进军商业贷款。所以呢，也希望今天能为大家来答疑解惑。那么现在呢，我们就邀请这个Steve Fabian。那首先呢，我想先介绍一下 Steve Fabian 他的这个 background， 他的这个背景哈。那么 Steve Fabian 呢，他是安大略省金融服务协会FSCO 是 Financial Service Commission of Ontario 的董事会成员，也是安省贷款机构监管会的这个董事会成员。那么他也是这个Seneca College 以及这个 Real Estate Mortgage Institute of Canada 教育会的委员会成员以及教授。那么所以可能有些这个之前有在上这个贷款经济可能有些人都听过他之前的课。那么同时呢，他也是商业房地产贷款协会的董事会成员。那么之前呢是著名的这个lender MCAP 的前商业贷款总监。那么非常开心，再次欢迎我们 Steve Fabian 为我们带来今天精彩的讲座。So now, Steve, I pass to you. So please start our presentation today.
Thank you for the introduction. I wish I knew what you said, but I hope it's all good. I'm sure it is. All I can say in Mandarin is Ni hao ma. So welcome to everyone this evening. I wish there was more, but that's a few words, but that's about all. So really, what the conversation will be tonight is really just two parts. The first part will be introduction to commercial mortgages, some of the key concepts to consider, and especially as borrowers and investors, some of the things that you might come across, and you know, questions to ask your broker. And then secondly, we're just going to talk about the mortgage marketplace at large, and some of the options that are available, you know, outside of banks, and just to understand what brokers can offer you, and so on. So as we talk, so on in commercial mortgage, going to highlight a few, just to kind of give you a quick overview of what we're going to discuss, and give you some ideas of again, how to look at commercial mortgages. So going to compare very briefly the differences between borrowing on a commercial property versus borrowing on a residential property. Secondly, we're going to talk about the pricing, costs, fees that are typical for commercial mortgages, because they are different than residential deals. We'll talk about some of the deal timing and the length of the process and how long it takes, and a little bit about some of the documentation, because there is some different documentation between a residential deal and a commercial deal. And then very briefly, just going to talk about the application process so you can understand the deal flow and so on. So firstly, just the differences between a commercial mortgage on a commercial property and on a residential deal. So if you want to just change to the next slide. So the biggest difference, obviously, between a residential mortgage and a commercial mortgage is the analysis of the deal. And obviously, many of you own properties already, and many of you multiple properties. I'm told, and I assume most of them are residential properties. And the key analysis point for any real estate deal, there's really three factors. There's the income, there's the property analysis, and then there's the borrower information and credit. So the biggest difference on a residential deal, you measure the personal income, person's job, their business that it generates, so their personal income. On a commercial deal, you measure the income that the property generates. So the leases that it has, if it's a construction deal, how much value will be added, what the property can be sold for. So you're looking at the income of the property versus the income of the person. Obviously, on a residential deal, the property is important, but it's almost secondary, right? Always, you know, I'm sure you've seen this when you go for approval for a mortgage. They're concerned about your income and your credit. That's always the main drivers. That's what your bank representative or your mortgage broker is dealing with, is can you qualify the income and what's your credit. The property, as long as it's not unique, if it's a regular home or a condo, as long as it's not something unique, property is almost secondary. On a commercial deal, the property is the most important thing. So people, the lender is going to ask about details about the property, the size, the makeup, the structure, the height, the width. The property details are most important. And then, of course, the borrower's credit. Obviously, on a commercial deal, you're usually looking at a company, its financial statements, who owns the company. Is there a board, or there multiple shareholders, and so on. For a residential deal, it's usually one person. And in that, the analysis is similar in that, loan to value maximums are apply. On a commercial deal, for most banks, the maximum is 75% legally. For non-bank lenders, they can go as high as 100%, even over 100%. The appraisal is very, very different on a commercial deal. It's much more. There's much more information. There's more details. It's a much longer report. They have to provide a lot of information on the property, okay, and they are much more expensive. Residential appraisal could be $200 or $300. A commercial appraisal, depending on the size of the property, could be $3,000, $4,000, $5,000, $10,000 or more. Debt service. This is where people often get hung up. On a residential deal, it's again they're looking at your income. What are your personal debts? What's your credit card payments? Do you have loans, and so on. On a commercial deal, your personal debts really have no bearing. What they look at is how much is the property generated income. Let's say it's an apartment building. How much income is generated from the apartment rents? What are the expenses to operate the property? Property taxes for that property, not for you. They don't care what your car payments. They don't care what your credit cards is. What does it cost to operate that property, regardless of who owns it? So they don't. That's why they don't analyze the borrower. They analyze the property's income. This building generates this much income. This is the expenses for that building, regardless of who owns it. So I can own it. You can own it. 100 different borrowers can own it, but the income is always the same because they measure the income for the property, not for the person. Then income stability. Again, they don't care about your job. They care about what are the quality of the leases. How long are the leases? How long has the tenant been there? Is the tenant a good tenant? Can a tenant pay the lease? Credit rating. Again, corporate credit ratings on commercial deals really aren't looked at too much because they really care about the property. Only if it's a big corporate borrower they look at credit ratings. But again, your personal credit profile. Unless the only thing you look at on a commercial deal for the principal as the sponsor, as the guarantor, is is there a bankruptcy? Is there really bad credit? If you've got credit cards and so on, it's not a big issue. Okay, so let's go on to the next slide for timing. Just one key there, sorry, just before we go to the next slide is, you can see the 5 C's of credit apply to both residential and commercial. It's just how they're interpreted and what's important and how it plays out. That's something that your broker can help you understand and help you develop a plan to understand it. Thanks. Let's go to the next slide. So interest rates. What you'll find with commercial mortgages is that interest rates aren't published like you see on a residential deal. You don't, it's very rare that you would, if you go to TD Bank or you go to an MCAP or even a private lender or a MIC today, you can go on their website and you can see, okay, here's our rates, here's our loan to values, and so on. And you can figure out what the pricing would be roughly. That doesn't exist for commercial mortgages. If you go on TD Bank's website, commercial mortgages, they won't post their interest rates. If you go on MCAPs as an example, they won't post their interest rates for commercial mortgages. And the reason is because it really is deal specific. So they have to analyze your deal. You could have 2 properties side by side, which are the exact same property. 2 apartment buildings. They're both 10 stories. They both have 100 units. One can be owned by a very strong group and very good income and very well managed, and that maybe that property is borrowing at at 2%, and the one next door, which is the exact same property, similar deal size. Let's say they're both same mortgages. That property could maybe the interest rate is 8% or 12% because again different scenarios. So it really the fees. The interest rates can be all over the place in a commercial deal, deal specific, and the interest rates are not they're not published and based on a set rate. They're usually based off of bank yields, and they change minute to minute, day to day, as opposed to on a residential, you get a commitment now, it's good for 120 days or 190 days. But on a commercial deal, the rate can change every day. Fees. There are various fees that are that you will be paying on a commercial deal that you won't see on a residential deal. So those fees will be typically lender fees. So even your big bank will charge the borrower a fee. It could be half a percent, it could be 1%, depending on the deal. If you have to go to a secondary lender or a private lender, it could be 2 or 3%. So you do pay a lender fee, an administration fee to analyze the deal. The reason for that is because, again, there's a lot of work. On a residential deal, I'm not bragging when I say this. If someone sends me an application for a residential borrower and they have a good application and their credit bureau and information on the property, with my level of experience, and not just mine, but anyone who's been in the industry for a long time, you can analyze the deal in 10 minutes, 15 minutes. And that's not exaggerating, that's how long it takes. Because, with experience, you look at the 3 key factors and it's very simple. On a commercial deal, even with my level of experience, every deal is different, and sometimes it could take me half a day, sometimes it take me 2 or 3 days to understand the deal. So that's why they charge a lender fee. And then there are reports. There's added costs that you won't have on a residential deal. There are the appraisal, as I mentioned before, the appraisal is very expensive. There are things like environmental reports, which, again, it's important because if the property, say it's an industrial property, if the property is contaminated, if there's oil spilled or whatever, that'll affect the value of the property. There's engineers reports. So that, you have a home inspector's report on a residential deal. On a commercial, you have to have a professional engineer come out who has to look at the structure and the concrete and the heating systems, the electrical systems, and those reports can cost thousands of dollars in some cases. There could be structural reports, there could be sound studies. Now, you don't have to pay these fees on every deal. They're not necessarily that they apply for every deal. It's just it is a possibility depending on the property that you purchase. So as I said before, that's why it's deal specific. What are the particulars of your property and your deal that'll drive the costs? Legal work. So the legal work on a commercial transaction, obviously because of the scope and nature of the deals, can be much more extensive. There is a lot more paperwork to do. There is a lot more information that has to be processed, especially when you have, in most cases, you do have a corporate borrower or a company or a partnership or something like, or an LP. So the amount of legal work required, you have multiple leases, multiple tenants, sometimes multiple properties. So there's a lot of legal work, where typically on a residential deal, the legal fee might be $1,000, $1,500, depending on the deal. On commercial deals, it could be, $5,000, $10,000. Complicated construction deals can be, $30,000, $40,000 because there's lots of moving pieces, lots of legal work. Just on a side note, I urge all of you, if you are going to be buying commercial properties, big or small, even a small store, one retail store, and maybe an apartment or 2 above. I speak to. I'm not a lawyer. I can't give you legal advice, but I can give you practical advice from the industry. Always set up a corporation or a partnership or a limited entity that isn't you personally, for liability reasons. It's you don't want to have to deal with a commercial property and being sued by neighbors and so on. Work because they come after your personal. So always set up an entity that's outside of you personally. So very quickly, I want to talk about the application process, because that's where people often get hung up if it's their first time or second time maybe investing in commercial properties. The process between residential and a commercial property is very, very different. With a good application, a good broker can send in your file today to a lender and quite often get the approval back the same day, get a commitment letter to you. On a commercial transaction, it just doesn't happen because of the process. So it's a timing in the process. So in most cases, with a commercial transaction, the broker's going to send in a package of information. They're going to take their time. They're usually going to come back to you with an LOI, okay, a letter of interest. They're going to tell you, this is what we think about your property and your deal. This is what our pricing will be, how much our loan can be, and the requirements they're going to have, all the documentation and studies they want you to provide. Once you sign that back, then they'll go and, now you have to go through the process of getting the appraisal report, getting the environmental reports, submitting your financial statements, all, submitting whatever information they require from you, legal information, your personal information and so on. That's sometimes, between waiting for the reports to come back from the engineers and from the appraiser and the legal work and so on, it can sometimes take, 6, 7, 8 weeks sometimes. It could take longer if it's a very complicated deal. So what I want to always urge people, especially if you're new to investing in commercial properties, and hopefully you're working with with a realtor that has some experience, is make sure you give yourself time. On a residential deal, it's common that you go out and buy a property today, and you might have a 1 week financing condition. That's usually sufficient. Maybe 2 weeks at the most. That's usually sufficient for most borrowers. On a commercial transaction, you can't do that. You need to give yourselves, in my advice, when I deal with borrowers, is give yourself at least 4 weeks, 6 weeks, depending on the deal. I might tell you if it's very complicated, I would tell you give yourself 2 months. So you really have to make sure you give yourself time to the deal process. So just, again, you're going to have a lot of documentation. Your broker will help you with this and be able to help you, understand what is required, when it's required, and why it's required. Do be prepared for a lot more documentation. They're going to ask for information on you. In commercial deals, you're always going to have, as I mentioned, so especially on small commercial deals and even on large construction deals, even the largest borrowers, you have to understand that you're going to have the property is key, as I mentioned before. They're going to take all the property information, the documentation on the income, the corporate structure, the legal information on who owns the company, leases, financial reports for their property, income statements for their property, tax statements for their property, and so on. All that's related to the property. But at the same time, because of the risks sometimes associated with commercial mortgages, and also just the norm in Canada is to always have what's called personal recourse. So personal recourse is where I, as the principal shareholder or owner of the company, or maybe it's you and your partner, or you and your wife, or your husband, or maybe there's 3 or 4 of you, but the main owners of the borrowing entity are also going to be signing a personal guarantee for that mortgages. So you're going to have provide all that personal information, your own personal application, your personal credit. They might ask for your personal financial information. If you're self-employed, they might ask for, so again, you're going to have to deal with all of that added paperwork of both the property, the corporate information, and the personal information. And again, your broker will help you understand and process it and understand why it's important and what's required. Again, lastly, just understand the process, because it does take time and you want to be cognizant of it. Is typically you get an LOI. And an LOI is a letter of interest. I think I mentioned it before quickly, but LOI is basically that the lender has seen the basic information on your deal. They understand, what the property is, how much of a mortgage you want, some of the basic information that you've presented early stage, because they're not going to see everything because it's just too much to look for. And they're going to say, okay, we think you understand your deal. We like the property. We think the income is good. We think that you're a strong borrower or suitable borrower. So, based on that, here's our letter of interest. It's called letter of interest or letter of intent, you'll see sometimes. And that letter of interest says, okay, based on what you've told us so far, we're going to give you a mortgage of $3 million. Our interest rate is going to be prime plus 2%. It's going to be a floating rate. We're going to give you a maximum of 70% loan to value. We're going to give you a 3-year term and a 30-year amortization. So they're going to give you the conditions, the make of the deal. Then they're going to tell you what they want to see: financial statements, appraisals, tax statements, et cetera, et cetera, et cetera. And so what happens is you like the LOI, you think it's the right offer for you, you sign it back. They're going to ask you, almost 99 times out of 100, they're going to ask you for a deposit at that stage. And that's a deposit towards the lender's fee, okay? Because the lender's going to say, again, I have to do a lot of work to analyze your deal. In the commercial world, and it's not like a residential deal where they do it for free. In the commercial world, banks, small secondary lenders, trust companies, private lenders, they all take a fee up front. Not a full fee, but a deposit. So it might be a few $1,000s. and they'll say, okay, now send me all that information. We're going to analyze your deal. That'll take, as I said before, it could take 4 weeks, 5 weeks, 6 weeks, depending on how long it takes to get, it might take a month to get the appraisal back. Might take 3 weeks to get the engineer's report back, get the environmental report, to get, maybe your accountant has to finish your financial statements. So it could take long, right? Once they've got everything they need, they're going to approve the deal. And then at that point, they're going to give you a commitment letter. The commitment letter, like a residential deal, is the formal, you've been approved, here are the rates and terms, and there might still be some conditions that have to be satisfied, legal work and so on. And then at that point, that's when you have a firm deal. And then, of course, now at that point, it's going to go to your lawyer for closing. And again, the closing could be several weeks, depending on how complicated the deal is, how much information you have available. Maybe you haven't, maybe your financial statements aren't complete. Maybe your legal work is not all up to order. Maybe your personal taxes, whatever the situation is. You have to be prepared for that time frame of having a deal complete. So again, that's a very very quick introduction. Obviously we're available after, but to questions by email and so on to help if you have particular questions. We'll take a few questions now. Angela, if you have a few questions, we can certainly.
So the first question that I have is, for example, someone sent me a question saying that they have a very good credit, they have a very good job, then how come they cannot get approved for a small mixed-use property? Why cannot they get approved since they have a awesome credit and good job?
Great, that's a very good question. It goes back to what I said kind of right at the beginning. Let's all a good example. I can give you a real example from a client. So I had a client who was a doctor. Personal income was very, very strong. Credit was, like 860 credit score, very low debts. So his personal, he could walk into his bank, get a residential mortgage in half an hour. But he was looking to buy, it wasn't a store apartment. He was looking to buy a small apartment building. And it was denied by his bank. And he had been a TD Bank customer, or I think it was Royal, whichever bank it was, but he had been a bank customer for a long time. And he was frustrated that they turned him down. The reason, answering the question, is because the key driver, as I mentioned before, of a commercial deal is the property. So in this case, the apartment building was very old. It needed a lot of repair work. I think it was, I can't remember the exact number, but I think his purchase price was around $2.5 million was the purchase price of the property as it is now. But it needed like almost another $1 million to fix the roof, fix the parking, fix the electrical systems. It was, an old apartment building where it looked horrible. So it needed a lot of work. And based on the type of tenants it had now and the level of expenses and income, there just wasn't enough income in the property to support the mortgage. So even though he personally is very strong, again, the first thing the lender looks at is the property. If you remember what I said before, is they want to look at the property as its own. Who cares who owns it? I can own it, you can own it, this doctor can own it, a billionaire can own it. They want to look first at the property. Does the property qualify? Does the value make sense? Is there enough income to support it? So again, in that case, if the property is so bad, no matter how strong the borrower is, it doesn't get approved.
Thank you so much. Definitely. So looking at the property as a whole thing compared with, that who's the owner, that's not the most important thing. So definitely now we got this answer. My second question is why the commercial rates compared with the resident rates are different? Like how, can you please provide some insights on this part?
Sure. It's twofold. One is cost of borrowing. It's what's called cost of funds. That's cost of funds to the interest. So if it's an institutional lender like a bank or a credit union or a trust company, their cost of funds internally are higher on a commercial mortgage because they have a higher risk rating. So with OSFI, the regulator, and banking practices and rules, what they do, it's called a risk adjusted analysis. So they analyze the risk. The potential loss, on a residential deal is much lower than a potential loss on a commercial deal. So the internal cost of funds is higher. And then secondary to that, you have just market dynamics, right? So the residential space in Canada is as much as people don't believe this, the residential space in Canada is about 10 times the size of the commercial marketplace. So I think on annual volumes in the residential business in Canada is like 1.3 or 1.4 trillion, where in the commercial, well, not quite 10 times. The commercial space is probably about 200 billion, 250 billion. So it's, maybe 6 times the size of the residential marketplace. So naturally, like anything, if mass market, drives the pricing, right? So you've got such a big market, there's so much capital available, so much competition, it keeps the prices down. On a commercial marketplace, you've got less choices and higher risk, so naturally the pricing's higher. It's just a function of that.
So another question is, do you have a lender product or underwriting the requirement sheet that you can share or criteria that you can share?
I wish. I say I wish because it would make my job easier. Yeah, no, it just doesn't exist. It doesn't exist because, again, sort of I said before very briefly, it's just that the scope, there's no way to, there's no way to pigeonhole and say, on a residential deed, it's very, the metric's simple. Beacon score between, 600 and 625, between 625 and 650 and so on, and loan to value, 65%, 70, 75, 88, and so on. So the metrics are very simple. It's a very simple box, right? It's simple metrics. And of course, as long as the property is not unique, you just plug in, it's 90% loan to value, 700 beacon score, that's the price. It's 85% loan to value, 650 beacon score, that's the price. On a commercial deal, you just can't do that. And I touched on it briefly before, but because you could have similar properties side by side. You could have 3 office buildings. They look the same. They're all the same value, but one is 10% vacant, one is 90% vacant, and one is owned by the worst borrower in the world. So it's impossible to pigeonhole them because it's really deal specific, right? So yeah, that's the biggest challenge, is that no 2 commercial deals, even though they might seem the same, even for the same borrower sometimes, right? You have a borrower who's very strong today and he buys one apartment building, 6 months, and just think of it logically. If you had a strong apartment owner who bought a property 2 years ago, he could walk into his bank, get a loan to value, a CMHC insured mortgage on an apartment building at 95%, 90%, 85%, 90% loan to value. But now, today in COVID, same strong borrower, it's a very different situation. So that's the challenge. Each property, each deal is really specific unto itself.
Right. Okay.
Yeah, absolutely. It could be. You're absolutely right. It could be. You talk to. And you're absolutely right. You could talk to. Sometimes, let's say you use TD Bank as an example, or MCAP, or any lender. You could talk to one person there. They might have a different interpretation than somebody else, even at the same institution, because they see the deal differently. So, because that matrix doesn't exist. You're absolutely right. Yeah.
So another question is, how long usually, let's say when you submit a case, so how long usually would get the answer back, like timeline perspective?
Yeah, there's no usual. I guess the way to answer that is hopefully you're dealing with a broker, or you're dealing at a bank branch with someone that's experienced in commercial mortgages. Obviously, I encourage you to use brokers, but there's lots of good people at everywhere. But hopefully you're dealing with someone there that is competent. That's the first part, and hopefully with a level of experience, they should be able to tell you, okay, you've given me X, Y, Z information. I still need this, but based on what I have so far, I can understand it, and I think we at least get an LOI. It's going to take us 2 weeks, or it's going to take 10 days because of the type of deal. So really, it's going to be there is no usual. The early stage of just getting an LOI. Well, if you have a good quality, good basic information, like the lender needs to know is what's the property, what kind of income does the property generate, a little bit about you, the borrower, and your entity, and then again just a little bit about the income of the property and so on. So usually you can get an LOI in maybe 3 or 4 days to get the LOI, but then it could take weeks to get the actual proper final commitment. Again, it's just getting back all the documentation. So there's no typical, but I mean the initial LOI with good information and a good person helping you, you could get an LOI sometimes in 3, 4, 5 days.
Perfect.
Thank you. Okay, so we're going to talk about the mortgage broker marketplace. So what I wanted to talk to you is, again, I know most people are familiar in Canada with the 5 big banks, and more and more there's obviously the banks are great. They're a huge part of the mortgage marketplace, but there are other options. And those options can be brought to you through your broker channels. So what is a broker? I think just let's talk about that very quickly. What does a broker do, and who is a broker? So a mortgage broker, much like an insurance broker, right, is the word broker, it means is an intermediary, someone between. So you've got a lender here and a borrower here, and the broker is the person in the middle who helps the two find a deal that fits. So that's what a mortgage broker does. A mortgage broker is someone that works for you to find, obviously, first of all, to understand your deal. Now I'm talking about residential or commercial, any deal. So the broker understands your particular situation, your challenges, your issues. Many of you obviously own investment properties. You could have very strong credit, good income, good self-employment, whatever but now you own 6, 7 condo units, or 8 homes, or a couple of small apartment buildings and a bunch of whatever the mix is. So obviously, many of you will have seen that the more properties you own, the more complicated it comes to borrow, especially for the big banks. And to defend the banks a little bit, it's not because the banks don't want to give you business; it's because the regulations sometimes don't allow them. OSFI, the regulator, has over the last 10 years changed the rules many times. Really, almost every 2 years, they've made significant changes to the mortgage rules, which made it harder and harder for people to borrow. So the good thing about where a broker can help is that a broker has access to multiple lenders. If you walk into your bank branch, that bank person has one choice, right? The products of that TD Bank or Royal Bank or CIBC, they have that bank's products. You walk into your broker's office, they literally have, in the mortgage marketplace in Canada, the residential mortgage marketplace in Canada, there's over 100, 150 lenders. In the commercial space, there's just as many. So there's hundreds of choices with different products and different, opportunities. Okay. So that's what the broker does. They're the intermediate, the person between that helps you find your deal and helps you, understand how do we get things approved. Sorry. So the other thing that a broker can help is that they can provide, again, different choices, different options that you can't get at your bank, and they can provide it in different scenarios, right? Where, again, if you walk into TD Bank, they're going to say, okay, this is, a residential deal. This is what our pricing, we can do, 75% loan to value. Here's our pricing. And you can go to a broker, and a broker can get you a bank deal. They can get you, TD, Scotia, HSBC, Laurentian Bank, RFA Bank. There's lots of direct lenders, direct bank lenders that your broker can get you approved at. And these banks have the same pricing and quality and reputation as as the 5 big banks. But the good thing of where a broker can help is that you can use secondary lenders, and they can use mortgage finance companies and credit unions and private lenders and so on, who can give you different products. So maybe a TD you can get 75%. Maybe your broker can give you an option that says, well, I can get you a mortgage approved at 90%. It's going to cost you a little bit more, but it gives you a lot more flexibility. Okay, and again, because of that, the broker can has the opportunity to really focus on a solution that fits you. And it's not a negative, but again, when you're at a bank institution, you have to fit their products. Where a broker can work on your scenario, understand you and your choices and your options, and really find a solution that fits you. So it's a borrower-focused solution as opposed to a product-focused solution. That's the biggest difference that I find. I think she said at the beginning, I've been teaching the mortgage brokerage program for over 10 years at Seneca College and with REMIC, and that's where I hope people can start to understand that brokers can offer you a borrower-focused solution. So they don't have to try and sell you one product. I can go to 10 different lenders and find the product that fits you. I used to work for 2 of the big banks, and when I worked there, they're great. I'm not beating up the banks. They're very good, and of course they offer lots of good products and so on. But when I was working at one of the big banks, I could only offer one product. And now as a broker, and we also lend ourselves, we can offer, I can offer you 10 different solutions for the same property. So that's the biggest difference, I think, what a broker does versus what just going to your bank directly does. If you actually want to skip ahead a slide, please. Let's go. Actually, I already talked. Let's go to the next one. Sorry, I kind of jumped around a little bit. So I want to talk to you a little bit about lenders to understand when we talk about lenders that a broker can offer you, what the differences are, and so for many of you, it's customary that people don't think about that. I'm sure if all of you did this exercise right now, grab your wallet and take out your bank cards and your credit cards. Myself included, I would find that you'd probably have your bank card as, say, Royal Bank, and you've got a Visa card from TD, and maybe you've got a second bank account, at BMO. And that's true for probably like 95% of Canadians. The big banks in Canada, especially in Canada compared to, say, the United States or Asia or in Europe, the 5 big banks in Canada have a massive market share, and we know that. So I would be surprised that I'm not sure how many people on this call. I think there's several hundred. I would be surprised if one of you could email or text Angela and say, I don't have a product at one of the 5 big banks. I don't think anyone that exists. But that said, there are lots of other choices. So when people think of big banks, they think of the 5 big ones, right? TD, Scotia, RBC, BMO, and CIBC. But there are lots of other big banks that are Canadian and foreign that can offer you the same product. So, there's Laurentian Bank, there's National Bank of Canada, there's HSBC here, there's obviously like Bank of China, Bank of East Asia, there's, RFA Bank, there's Versa Bank, there's lots of Equitable Bank, Home Trust, Home Bank, now Home Trust. So there's lots of banks and trust companies. In the past, we would have differentiated between trust companies and banks. So like a home trust would have been a second class, different to a bank, but now they've all become really big banks. So Home Trust and Equitable Trust and Concentra. So all the trust companies have also become banks now. That's because of regulation and so on. So most, and all the banks also own trust companies. So the first class is kind of trust and banks, and those are chartered by the government. So what that means is that in most cases, they have a federal license from the federal government of Canada to do business as a bank, to very literally print money. We don't have enough time to discuss that. But a bank charter or a trust company charter, also a credit union charter, is literally a license to print and make money. And that's what affords them the ability to generate loans and to help the economy and so on. Okay? But again, through the broker community, you have many more choices than just the 5 big ones. There are lots of banks that are available to you with the same rate, the same quality deals, and just more different opportunities, right? That's which is important to many of you. I understand are obviously your property investors. So you've gone to maybe TD or BMO, you've got 2 or 3 mortgages with them. Now they can't do it. Well, your broker can still get a bank deal for you at Laurentian Bank or an RFA Bank or Canada Western Bank. So there's lots of choices. Okay? The next group of lenders, it's about credit unions. So credit unions are thankfully, and I say that because it's good for the marketplace, over the last 10 or 15 years, some of the big credit unions have really started to grow in Canada. In Quebec, Desjardins is the biggest credit union in the country. They also have branches across the country here in Ontario as well. Desjardins is the biggest credit union by far. Desjardins is, if on an aggregate, is also bigger. It would be the 4th biggest financial institution, I believe. So it's not as big as TD or RBC. I think it's a little bit smaller than Scotia, maybe smaller than Manulife, but it's definitely like Desjardins is bigger than BMO and bigger than CIBC. And they're very concentrated in Quebec, but they're big everywhere else now. And so what a credit union is, there are big credit unions in Ontario like Meridian, Alterna, there's Concentra, so there's Van City and Vancouver, lots of big credit unions. What a credit union is, if you're not familiar with it very quickly, is that any of us, the public, we go into the bank, we open a deposit account, we're part of the ownership. So a credit union is basically a cooperative. So anyone who has an account at that institution owns part of that institution, and their pool of capital is lent back to other members. So it's a very good option. It's very good, especially for small business, that many of you are, I believe, and also very good for small investors because, again, they're friendly because you, the borrower, owns that institution. So they're very good options. Your broker will have access to many credit unions. Credit unions can offer you pricing basically as good as a bank, and with special things. So most of you, if you've borrowed, most of you I know have borrowed multiple times. Just a couple of years ago, they introduced a stress test in Canada where they applied a fabricated interest rate. So even though you could borrow at 2%, the banks had to calculate your debt service at 5.15, 5.25. So they had a stress test because rates are so low and they thought rates must go higher. Credit unions don't. That rule doesn't apply to a credit union. So a credit union can offer you a mortgage rate as good as a bank with no stress tests and a lot more flexibility. The third one I want to talk about is what's called a mortgage finance company. You will sometimes see them also called monoline lenders. Now, these are big financial institutions that aren't banks and don't have a charter of any sort. So just going back quickly, so a bank has a charter from the federal government. Trust companies can have charters from the federal government or a provincial government, and credit unions also have a charter from the federal government or provincial. Most credit unions are provincial, some are federal, but they have a license from a charter from the government. A mortgage finance company is what, if you look in the media sometimes, the media that speaks about them negatively, they'll call them shadow banks. That's not a positive term, and I think that's a wrong term to call them, but that's what some people in the media will call them. They call them shadow banks. But mortgage finance companies, basically, in many cases, private companies like MCAP. I used to work at MCAP. I think they're the biggest now, or second biggest non-bank lender in the country. This is a massive institution. They manage like $120 billion in mortgages. There's a company called First National Financial, which is basically the exact same size. They're both around 100, 110, $120 million in assets. They are massive non-bank finance companies. There's lots of other ones, Canadiana, Lendwise, Merrick's. There's lots of options. These institutions are what's called monoline, meaning that all of their lending is done, in most cases, their focus is residential. They all have a commercial division, but their focus is residential. And most of their virtually all their lending is done what's called securitized. So they create mortgages into bonds and they sell it through CMHC bonds. I don't want to complicate it, but they can offer you very good pricing. And what it means by monoline lenders, it's all they do is lend. They don't have bank accounts. They don't have credit cards. They can't offer you RSPs and all that kind of stuff. They're just lenders, mortgage lenders. Okay. But they can offer you very good pricing. If you talk to your broker and you start comparing, in most cases they can actually offer you pricing that's better than the bank because they have flexibility. Your broker can sometimes, there's specials, they can buy down the rates. There's lots of flexibility. They can actually offer you better pricing than the banks. And then the last one, which is a very big group, is what's called a mortgage investment entity. A mortgage investment entity is really any company that invests in mortgages and that money is lent out. The most common one is what's called a MIC, which is a mortgage investment corporation. I'm sure most of you have seen that. Many of you have probably dealt with it. I'm sure many of you have even invested in a MIC. So a MIC is a mortgage investment company. What that MIC is basically, it's a pool of capital. So all the investors, you might have 100 people, you might have 1,000. They contribute their capital into this corporation, and that corporation takes that money and lends it out to borrowers. Most MICs operate in what you'd call the secondary market or the B market. Some people use the word subprime. That's a negative, but they operate in that secondary and third level of lending, where there's maybe some borrower challenges, or maybe people have too many properties that can't get a deal approved at a bank or a mortgage finance company anymore. So they have to go to these secondary lenders, okay? And the rates will be higher, right? There's probably usually a higher fee, but they afford you the opportunity to do business and to still make investment that maybe you want to buy an investment property, but your bank won't allow it anymore. And mortgage investment entity, sometimes they're what's called a mortgage fund, and then of course you could just be a private lender. So just to give you, for instance, like the company, my company, we are a broker, but we also have our own funds. So we lend money from the ownership of the company, and then we also have we manage in mortgage investments for other third parties. So like family offices or very high net worth people or some small institutions. We will act as a lender, so we lend on their behalf, and we are a mortgage investment entity. But we're not a MIC. So a MIC is a pool, a specific pool of capital, where there are other, you could be a private lender direct, you could be a mortgage fund. So there's different entities that will lend to you outside of the institutions. And again, there definitely are generally a higher rate. They are much more flexible for sure. So on a commercial deal or on a construction deal, for example, you go to a company like mine, we'll sometimes give people 100% loan to cost, right? Because we know that they're going to spend money in the property, they're going to increase the value, they're going to build townhomes and sell them in 6 months or whatever. So you have a lot more flexibility with a mortgage investment entity. Okay, so that's very quickly. That's kind of the 4 tiers of lenders. Most people in the Canadian marketplace aren't aware of that. And for those of you, for your group, as property investors, you want to start educating yourself. Obviously, speak to a good broker who can introduce you to all 4 of them and tell you the pros and cons of each, the products that each offer, the rates and fees associated with the different types of lenders, and of course the different flexibility, which is sometimes becomes paramount. I know sometimes borrowers, and I say this to borrowers all the time, and I don't say it lightly. I know that human nature sometimes always makes you want to ask, that it has to be a bank deal because I want to pay the absolute lowest rate. But when you're making a mortgage, or getting a mortgage for an investment property, sometimes you have to consider that necessarily the lowest rate isn't always necessarily the best thing for you, because maybe flexibility is more important, right? Maybe you can go to TD Bank and get approved for a mortgage for that investment property, but they're only going to give you 65% loan to value. Yes, it's going to be 2.5% on a small commercial property, or that investment condo. It's going to be 2%, but they're only going to give you 65% loan to value. Maybe you can go to their credit union, and maybe it's going to be, instead of 2%, maybe it's going to be 3% interest rate, but they're going to give you 75 or 80% loan to value. So that extra working capital you can use to maybe invest in another property, to improve another property you have, to do other investments outside of real estate. So sometimes you have to, and I understand the group, most of you have more and more investment properties. Sometimes don't just get focused only. I'm not saying obviously you want to pay as little as you can, but look at the whole picture, because sometimes maybe paying 0.5% interest on this investment property, but putting less capital in, or being able to buy more properties is going to make you more income and more net worth than just saving 0.5% of interest. Okay. Also remember, I talk about this. I'm not an accountant, so I can't give you tax advice, but again, I can talk to you about experiential. On investment properties, the interest you pay is tax deductible. So I've actually had very sophisticated borrowers come to me sometimes, and you'd be surprised, they actually don't want to pay the lowest rate. We offer them on 4%. They're okay. They actually want to pay 4.5% or 5% because they have multiple income streams, and that interest is it's a pure tax write-off, and it allows them to better manage their cash flow and so on. So again, you have to have a full conversation when you enroll in investment properties. Don't get hung up on just having the lowest rate and so on, especially when you have multiple properties. So think about things holistically, because there are different options. Okay. Just lastly, I want to just highlight some key, just the last slide, to keep your options open. Yeah, that one. Thank you. to highlight some of the key facts again, because there are different choices, and I've worked for two of the biggest banks. I just want to, again, I'm not anti-bank, but I just want to always tell people there are lots of choices, and and sometimes people don't think, oh, I didn't get approved at TD Bank. My brokers told me I get approved at this company, MCAP. Like, what's MCAP? Who are they? Or what is this credit union? Who are they? So just some facts to consider, because these institutions are big. So last year, 54% of Canadians obtained their mortgage through a bank. The year before, it was 62%. So that's, that seems like a small difference from 62 to 54. But again, that's a massive number. I mean, again, as I mentioned before, the mortgage marketplace is massive. So that 6% decrease means that, many Canadians, millions of dollars in mortgages weren't placed at a bank, but they were placed at all these different lenders. Okay. There's another key stat: 32% of mortgages arranged in 2018 were arranged by brokers. Okay, and if again, if you look at that's a lot of business, right? So 1/3 of mortgages in Canada were arranged by a broker. That means they didn't walk in directly to their bank; they went to a broker. Okay, and then just lastly, the credit unions, represented 10% of mortgages, right? So that's a big number. I just highlighted some key things here just to tell you that I know, again, it's very common for people to think, it has to be TD, it has to be RBC, it has to be Scotiabank, because you don't know who these other lenders are. But just to be cognizant and talk to your broker, because there are lots of options. Again, you can see that millions of Canadians and hundreds of billions of dollars in mortgages are placed with these other institutions, be it a credit union, be it a trust company, a mortgage finance company, or some of the mortgage entities, mix and so on. So there's lots of options, there's lots of choices, and again, you just have to be aware of it and make yourself realize. And again, you'll start to see that when you have multiple properties, you need to find those other options, because if you want to continue to build and grow your portfolio, you can't be stuck on having just the 5 Canadian banks, because there are limits to what they can do. Right? So that's really, in a very quick nutshell. I just to talk to my company very briefly. As I mentioned, we are a commercial. We are a brokerage. We do residential deals and we do commercial deals. Of course, we do both equally. We do also look at lending. Myself and Min runs our residential brokering, and I run the mortgage investment part of it and our commercial construction loans. But we do have, we do offer both products, and we do have lending that we lend directly ourselves. Most of our lending is commercial construction. We do some residential lending as well, but we do have options, and I'm happy to talk to you anytime about a deal. I guess if we have some questions too, happy to take some questions now, just to maybe clarify a couple of points. I know it's very short, so I went quickly. I hope it didn't go too quickly, but hopefully we can answer a couple of questions.
So you said there's lots of choices, on the broker side. And then I think one of them, because I heard a lot of people are saying that tier 2 banks or brokers usually would charge a lending fee, like 1%. Is that applied to all the brokers, like second tier? Like, what's your comments on this piece?
It really depends on the deal. Certainly if the alternative lenders, if you want to call it that, like even still, so you could go to Home Trust or Equitable Trust, let's say, on a residential deal. They will charge a fee. Yeah, they generally do charge a fee, and the reason is because in their alternative products, I'm not talking about like an Equitable Bank as an example, as I mentioned before. Equitable, I talk about Equitable and Home because they're the two biggest and they dominate that sort of secondary B lender. So Equitable Bank is a bank and a trust company, and Home Trust is a bank and a trust company. So their traditional B product that people are associated with what you're asking, that B, maybe your credit's a little bit bruised, your income's not, your TDS is higher than 40, it's 50 or whatever, that B mortgage, it's on the trust side. Okay, so again, there's higher risk in the background, but the biggest difference is, and why they charge a fee, is that those mortgages don't qualify for CMHC insurance. They don't qualify for CMHC insurance at the mortgage level, and they don't qualify what's called bulk insurance. So bulk insurance means in the background that a bank will even if even mortgages at 50% loan to value, the borrower isn't paying a CMHC insurance, but the bank has insured the mortgage, so it drives down their cost and their risks. Those B mortgages can't, they don't qualify for bulk insurance. So the lender charges you a fee to basically to mitigate their risk and to create their own kind of security pool for that B product. So that's why they charge an application fee. It's just, again, it's risk reward, right? So you have a little bit higher risky deal, you're going to charge a fee. If you have a very risky deal where now you can't go to a trust company, you have to go to a private lender, yet every private lender is going to charge you a fee. I'll be honest with you, most private lenders, like even our company, because we manage investments for other investors in the background, I care about the rate because I care about, obviously I'm responsible to my investors, but most private, like companies like ours that manage investment, even a big company like MCAP, which is a mortgage finance company, they manage, as I said before, over $100 billion. The interest rate that they charge you, they don't get. That goes to the investor. So they're going to charge you a fee because that's their income, is the fee.
Thank you so much. Let me just ask one more last question. So currently, like CMHC provide a first-time home buyer incentives, which they can borrow you like 5% to 10%. What do you think? How hard it is to apply, this incentives? Because from my understanding, it's only like probably 100 deals since they actually launched this program. What do you think from your end?
Yeah, I'm not a big fan of it. I think I'm going to be honest. I think that program was politically motivated as opposed to actually moving the marketplace. I think because it looked good for the government to say, yeah, we did something. As you say yourself, I've talked to only a few thousand people in Canada have taken advantage of it because it's virtually. The banks don't want to do it, to be honest with you. The lenders don't want to do it because it's pretty risky product. You're really putting almost nothing down, right? And people recognize that it's very, very cumbersome and hard to qualify for. So I personally, I have no faith in it, to be honest with you. I think it was politically motivated because it allowed the government to say, yeah, we did something, which really, unfortunately, it didn't prove anything. And on the practical side of it, again, I like to. I hope that most brokers or most bank representatives you speak to really look at trying to understand the borrower. I just give you my own personal thing. If it's an investment property, I'm a big believer, get as much leverage as you can because it's an investment property. It's not your home. Who cares? So if you can get approved 90%, take it, right? Because you're going to make income. It's going to pay for itself. It should pay for itself. But if you're a first-time borrower and you can only qualify, you've got such a very, very small down payment, and your debt service, your payment's going to be tight. Probably not. I know a broker, you don't want to turn away business, but sometimes you have to give someone advice that maybe maybe it's worth waiting a year, save a little bit more money, so you have a little bit more down payment, so you're not so tight. And that's what I would tell borrowers sometimes.
Great, thank you so much. With the respect time, I think I got a lot of key takeaways today. So for example, the brokers definitely have much more choices compared with the tier 1 banks. And also in terms of rates, sometimes you shouldn't really focus on the low rates. You should think of how you can qualify mortgage, get your financing. That's the most important thing that you should focus. Another thing that I learned today, definitely, for commercial, there's definitely case by case. Definitely a lot of variables that you need to take a look. So if you have any questions, then definitely, ask Steve. So let me transfer to Chinese again. Sorry.
Yes, of course.
我们先
Yeah.
非常感谢那个Steve 来我们这边哈。那么呢现在已经快9:05了，那么大家可能还有一些问题，那么也欢迎大家呢可以跟 Steve 单独来联系。那么今天呢我也学到了很多的东西。那比如说像这个我们不应该只 focus 这个低的利率，我们应该要看说怎么样可以让我们的 mortgage 来批下来哈。那另外呢就是说如何选一个 brokers， 那么 brokers 也有非常的这个 choices， 非常多的选择。那么第三点呢，比如说像这个商业的贷款，那么商业的贷款呢是真是 case by case。那么每一个这个 case 也不一样哈，那么你的这个situation， 你的情况可能也在变化之中。那么如果大家有任何的问题呢，也欢迎你联系 Steve。 那么也希望各位群友继续一如既往的支持房东群，非常开心呢，今天晚上跟大家有一个面对面的云聚会的时光谢谢大家的收听，谢谢。Thank you so much, Steve. We will end for tonight. Thank you so much for your time today.
Yeah, you as well. Thank you, everyone there. I wanted to say, I guess, make sure I say it right. It's she, and one on. I think that's right. Is that right? Am I close?